Imagine earning $2, $3, even $400 a month from doing things that you already do by investing less than $1,000. That is the power of some of the passive income strategies that I will discuss in this video. In this video, I am going to go over 3 ways to earn passive income in crypto through the use of decentralized physical infrastructure networks. I will cover each project, what it does, what you have to do to make money, how much money you can expect to make, and then I will explain where the profits come from, the tokenomics, and the risks associated with each. Please leave a like and subscribe for more crypto videos in the future. Before we start our deep dive, nothing in this video is financial advice. I am not a financial advisor. Please consult a financial advisor before making any financial decisions. Let's dive into the first coin, Hivemapper. Honey is the token for Hivemapper, which is a project that is building a comprehensive map of all the streets in the world. It is a decentralized Google Maps competitor, where the revenue from companies using the data flows to the holders and earners of the Honey token. In order to start earning Honey tokens, you need a car. Go to their website and buy one of their dash cameras for $300. Then mount it on the dash of your car, and it will take pictures as you drive and upload them to the program when you are done. Depending on where you live, there might be bounties to go map new areas of the city or of an area close to your city. This is how you can earn extra Honey tokens. Whoever maps the new area in the specified amount of time will split the reward pot of Honey tokens. The more you drive, the more you will earn. This is perfect for people who drive a lot and on roads less traveled. For example, rideshare drivers or delivery drivers. If you don't have a car, you can still earn tokens from the Honey project, but it won't be passive. You can go into their map annotating game and help them train their AI model to identify items that appear close to the road. From YouTubers who have done this in the past, they have made anywhere from $200 to $400 a month, but with the bull run pushing the price of Honey up, this could increase dramatically in the future. With every project, there are risks. In the previous bull market, infrastructure like this was built, but the issue was that there was not enough demand. This is what happened with helium. So the question is, where does the demand come from for the Honey token? And how sustainable is that demand? Currently, there are a few sectors that demand the Honey token. Firstly, applications that are looking for map data. In the past, Uber paid Google $58 million to train on their data. Another demand point for this data are projects that need to have real-time data. This could be used for monitoring construction sites, billboards, and ensuring the functionality of critical infrastructure. The third demand point is for real estate assessments. The more up-to-date the data a model has on a certain area, the more accurate it can be. This is good for insurance, development, and other applications. Now that I covered some of the demand points, let's go over some of the risks. The first risk that I saw was that this project had unfavorable rules on their Discord. They banned talking about return on investment and ways to propel the project in the Discord. This is bearish as it signals that the devs can't take constructive criticism. This, if not fixed, will lead to other projects overtaking Hivemapper. Another risk for this project is that their marketing isn't that good. The only way I found out about this project was because I'm interested in this sector. How are they going to reach their target market so that their coin can stay up? The tokenomics for this aren't the best. Lots of coins from insiders are already vested, so expect there to be a significant amount of friction on the upside as investors cash in their profits. But in the bull market, this shouldn't be a huge issue, and the liquidity of this is thin. So if the advisors know how to trade and exit in a capital-efficient way, then it shouldn't be too bad. Long term, I see the profits shrinking substantially because as the supply of data increases, the value of the individual data points gets cheaper and the payouts will diminish. So it is best to be early on this to maximize gains from this. Additionally, there isn't a big moat on this project. Another project could come along and undercut Honey. They don't have a monopoly on the public roads in the same way that Google doesn't. Now let's look at the second project, DIMO. DIMO plugs into your car and allows you to sell the data that your car generates. This data is valuable. This gives you a monetary return on doing things that you do every day anyways. The data that it gathers includes vehicle health records, battery data, private GPS data. If you are nervous about that data getting collected and sold, that is a fair concern. But your car, if it is a modern model, probably already does that and it doesn't pay you anything. So this way you will get paid for what was already being sold. Now let's look at what has to be done to start earning some DIMO tokens. Buy an AutoPi for $299, plug it into the OBD2 port in your car, and then start driving. Or you can connect the app directly to your car if it is available, for example, if your car is a Tesla, Ford, or Toyota. Every week, equal amount of DIMO are distributed to each vehicle connected to the app that have been driven at least once per week. Connecting with the physical hardware gives you more rewards than connecting to the app. The more you drive, you level up and the more you earn. Note that this service is not available in every country. It is only available currently in the US, Canada, the UK, the EU, Norway, Switzerland, and Turkey. You will get paid anywhere from $50 to $100 per month. Rewards are paid in the token, so if the token appreciates, this will go up. If you drive more, you produce more data and can get more rewards. The money would come from companies looking to use the car data in their models. But in the past, there have been difficulties in connecting with buyers. Two companies that tried to do this previously without crypto are Tokenomics and Godet. Tokenomics did a SPAC and started with a $1.4 billion valuation. Right now, the company is worth $50 million. They got delisted from the NASDAQ and had to do a 14-to-1 reverse stock split. Godet went bankrupt. So there is not a great track record for this industry, even though some McKinsey consultants believe this data could be worth $750 billion by 2030. These companies also didn't manage their capital effectively, so it is very possible that DIMO will wait it out and be able to pounce on this opportunity. Now let's dive deeper into the risks and tokenomics. Firstly, the demand side is weak. Other companies have tried and failed in the past. If DIMO gets this right, then it is off to the races. Now to look at the tokenomics and emissions schedule. These are the allocations. Still some time for tokens to be vested, so all in not too bad for tokenomics. But there is one thing that is standing in the way of this token flying, and that is that it has high emissions. $250,000 a week, $1 million a month at current prices. And you can bet that a lot of the people who are using this for passive income are going to be dumping those rewards every week. One thing that is tough is that the pool will be distributed over 40 years by issuing 1.1 million DIMO to users per week for the first year, with issuance decreasing by 15% each year. So this means that approximately $250,000 of coins will be coming onto the market each week of the year. So in order for the coin to maintain, there will have to be $250,000 or more of buy pressure coming on every week. There is some risk in this project, but the market is validated. If DIMO can find the demand for this data, then it is going to be very lucrative for the people selling their data. Also, you should know that they emit a fixed amount every week, so the more cars that come on, the less each person will get. So if you want to get in, you should get in sooner rather than later. The final project we will look at is Geodnet. Geodnet is a decentralized weather data collection system. They use the data that you produce with their hardware to help commercial applications of satellite data. This helps to increase the accuracy of data collected and allow more precise models to be made. Accuracy on GPS goes from multiple feet to a few centimeters. All you have to do to start earning is to set up a space weather station on your roof with a clear view of the sky. Buy a node for $595. Attach it and let it run passively. If you run a node, you can expect up to 48 geode per day if using a triple band miner, 24 GOD per day, as a dual band miner. Right now, that breaks down to about $115 a month, and it will take just over 5 months to break even on your investment in the node. There is also a multiplier effect, similar to the bounty system that Hivemapper uses to incentivize their network participants to map new areas. Geodnet has already generated $250,000 in revenue and has signed contracts with at least 10 companies. In their Discord, they claim that they can't share all the companies that they are doing business with due to non-disclosure agreements, so investors are just going to have to take their word for it. And a more advanced analytics dashboard has been teased for the future. One green flag is that there are companies in the space that already do this successfully, namely Trimble, which is a company that has a market cap of almost $13 billion. At this point, we are investing into the management team of the project as the fundamental information available isn't very abundant. But according to the podcasts that have come out, we are in good hands. Looking at Tokenomics, we see that this project has 1 billion tokens that were pre-mined. Investors, ecosystem, and team tokens vest over 3 years. The tokens that are emitted to miners are rewarded over a period of 10 years, with the emissions halving annually June 30th. The coin is only currently on DEXs and the liquidity is very thin, so make sure to be capital efficient when entering. In conclusion, make sure you always evaluate the long-term feasibility of these projects before you invest. If there is not sufficient demand, the token is going to zero. If you like this video, please leave a like and subscribe. Also follow me on Twitter @DailyMoonCrypto.